I had a few of you reach out and requested that I review this article here on Seeking Alpha titled DGRO, Not an Attractive Dividend Growth Play, written here from Stone Fox Capital. I am so excited to share that today's video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to track my dividend income and analyze my portfolio. Whether you're a new or existing Snowball Analytics user, use promo code DGI to get the very best pricing. So there's a few things that I agree with in this article, and the overwhelming majority I disagree and don't think that the author of this article really knew what they were talking about. So I wanted to stay open when looking at this article. Obviously, the article takes a few punches, right? The title is Not an Attractive Dividend Growth Play, where I think that that's not the case. I think it is an attractive dividend growth play, but I wanted to be open and see what this person had to say and see if they could maybe change my mind. Maybe they're seeing something that I'm not. So I've seen Stone Fox Capital on Seeking Alpha before, but I've never really read his articles. And I wanted to see, okay, well, who is this person? Does this person, specialize in income investing? Are they a dividend investor? So about Stone Fox Capital, so he's a CPA. He has a degree in accounting and finance. He has also a Series 65. Okay, so he's very well qualified. He leads an investing group, Outfox the Street, where he shares stock picks and deep research to help readers uncover potential multi-baggers while managing portfolio risk via diversification. So right off the bat here, when I see somebody say multi-baggers, it sounds like something that you would see in like a TikTok video from a 16-year-old. So simply by using the word multi-bagger, why are you reviewing DGRO if you're interested in multi-baggers? So when I first read this kind of scratched my head. I was like, what is this guy doing reviewing DGRO if he's talking about multi-baggers? So he has an investing group. So let's take a look at this. So his investment group here on Seeking Alpha, what does he do? So he's looking for the next multi-bagger stock. So if he's looking for the next oh my gosh, he's looking for the next multi-bagger stock, and he's talking about DGRO. What is this guy doing? We do a deep dive in misunderstood stock stories. Is DGRO a misunderstood stock story, such as beaten down SPACs? So this guy specializes in multi-baggers and SPACs, unprofitable SPACs, and this guy's going to do an article on DGRO. I'm a little bit skeptical. What does this even cost? What does it cost to be a member of his group? It costs over $300. I'm going to pay him $300 a year so that he can tell me about unprofitable SPACs while writing about DGRO, a dividend growth ETF on Seeking Alpha. Something doesn't really add up when you think about that. So the summary of this article, the iShares Core Dividend Growth ETF's top holdings often have unattractive profiles leading to market underperformance versus the S&P 500. Now, I marked this in red if you're only listening. I have this marked in red because this is just blatantly not true. If you look at the past performance, of the top 10 holdings of this ETF, DGRO, 7 of 10 have actually outperformed the S&P 500 over the last 5 years. So him saying that they've underperformed is actually intellectually dishonest. Now, you could maybe skew the data, and if you were to look at a different time frame, then yeah, maybe. But over the last 5 years, on a total return basis, 7 of the 10 top holdings have actually outperformed the S&P 500. So I don't know why he's lying or making you believe something that's actually not true. Anyways, moving on, the ETF focuses on large companies with low dividend yields, missing out on growth opportunities from non-dividend paying stocks. Now, we're talking about a dividend growth ETF, and he's making the argument that this is not an attractive play because it doesn't include dividend stocks. What are you thinking? Like they let anybody on Seeking Alpha, apparently. What are you thinking? You're complaining that a dividend ETF that is screened for dividend growth, and he probably doesn't know that it's screened for dividend growth because he didn't even look at the index methodology. That's how ridiculous this article is. He's complaining that it's missing growth from non-dividend paying stocks. This guy should stick with SPACs and try to grift you with his next profitable penny stock, because what is this guy thinking? So this second bullet point of the summary of this article is intellectually dishonest and untrue. It literally states in the fund methodology, in the index methodology, that it focuses on higher yielding stocks. It's actually quite literally a screener that they focus on higher yielding stocks based off of how the index is set up. And I will show you that here later, what the actual index is and what it screens for. But this is intellectually dishonest. It is not true what he's saying here. And the fact that he threw this in here, missing out on growth opportunities from non-dividend stocks. He's reviewing a dividend ETF and complaining that there's not enough non-dividend stocks in there. Oh my gosh. Okay, anyway, so moving on here. Despite solid returns, DGRO consistently trails the S&P 500, questioning its value over simply owning the index. Now, if you go over since the inception of the last 10 years, DGRO has underperformed on a total return basis the S&P 500. In fact, 6 out of the last 10 years, DGRO has underperformed. Okay, so this is factually true. This is correct. DGRO has performed better in bear markets. So in bull markets, like we've been in this year and last year as well, I guess you could say, the S&P 500 has outperformed. But when the market is down, DGRO has outperform. And it's just simply how the index is set up. So these 3 bullet points, his 3 points of, why this is, to quote the article here, and not an attractive dividend growth play, 2 of the 3 is just nonsense. But yeah, let's take a look at the article. So first off, he starts the article with saying that when looking at an ETF for potential investment, an investor should find a list of top holdings with attractive investment profiles. Too often, iShares Core Dividend Growth ETF DGRO lists top investments with unfavorable profiles. My investment thesis remains bearish on the Dividend Growth ETF due to the unfavorable history versus the benchmark index. Now, he wrote another article just a few months ago, back at the end of May of this year, chasing the wrong dividend growth. Now, this article is very similar and equally as ridiculous. I'm going to use the word ridiculous. There's a lot of other words that I could use, but let's stick with ridiculous. This article is so ridiculous because he's focusing on growth, but we just saw it earlier here that, the guy is complaining about a dividend index that doesn't hold enough non-paying dividend stocks in it, right? Like that's the rationale that this guy is using. But anyways, the thesis that he wrote from a few months ago, a whole lot's changed in a few months. But yeah, the only thing that's changed since then is that DGRO is up 10% since his last article a few months ago. The index holding problem. So the core dividend growth ETF claims to have a goal of investing in U.S. equities with a history of growing dividends. What the fund actually ends up owning is a list of the largest companies in history. Well, so first off, the largest companies in the world tend to pay a dividend. SPACs that he usually talks about, because his investing group is all about SPACs, unprofitable growth stocks in their early stage, they don't pay dividends, right? So established businesses that have, captured market share and have a moat in many cases, not all cases, they pay a dividend, right? And so clearly this guy needs to stay in his lane, his swim lane. I don't think he really knows what he's talking about, or I don't know if he understands that there's a different investor profile, who invests into SPACs and who invests into the largest companies in the world that pay dividends, right? Like there's just not a lot of overlap there, but I could be wrong. That's just my opinion. I don't know. It just seems so weird. The article is just so ridiculous. So moving on here, the ETF is loaded with companies that don't actually pay large dividends or where the dividend yields are rather unappealing. The issue here is typically a fund willing to overpay for consistent dividend growth versus finding stocks with dividend growth at attractive prices. Okay, so have you even read the index, like how the index screens companies? I don't think this guy has actually read the index. And as as an advisor or somebody that has an investment group, that is kind of scary, right? Like they let anybody write articles nowadays and do, manage money. It's insane. Like I can't believe that this is actually happening, that this guy doesn't even understand or take the time to look at the index. It's just, I don't know. It's blows my mind. The top stock in the fund is ExxonMobil, just off trading at an all-time high with still a solid 3.1% dividend yield. The next three stocks in the index don't actually pay large dividends, with neither Microsoft, Apple, or JP Morgan paying dividends, topping a 1% yield. So Microsoft is what, at all-time highs. These companies, the market's at all-time highs. Therefore, the forward starting yield is going down. Microsoft did increase its dividend, I think 10% over the last 2 years, right? So yes, these are large companies. Based off of when you buy them, where the market is at, it's going to all impact your forward yield. Yes. So I guess the argument that he's making here is these are large companies with small starting forward yields. Okay, I can get on board with that. I can agree with that. So while these stocks have generally performed well in the last few years, the low dividend yields are symptoms of overvaluation, not the lack of cash to pay larger dividends. All of these stocks are roughly 3% weighting in the core dividend growth ETF. Now, all of these stocks are at high valuations. The entire market is at high valuations. So this argument here of, hey, DGRO is overvalued, well, the overall market is overvalued as well, right? The forward dividend yield on the S&P 500 is at historic lows as well. So as a whole, the whole market is overvalued. So the natural implication is that growth is missed by only focusing on the stocks with dividend growth. The boom of the last few years came from chip stocks like AMD and Nvidia that didn't pay dividends or consistently grew the dividend, while a chip giant like Intel recently cut their dividend after a history of dividend growth. Now, wait a second. Now, you're saying that we should all go back in time and just have bought AMD and Nvidia? Is that really what you're saying? And to have sold Intel? This is so bad. Like, you're looking at a chart and say, hey, this stock did well. This stock didn't do well. Dummy, you should have bought this stock. I mean, what? Like, the logic behind that is so, like, okay. So the argument that he's making here is DGRO underperformed because it didn't have Nvidia and AMD, and it had, a chip giant maybe like Intel before it was removed from the index, right? So if you want pure growth and you want all the volatility and you can, predict the future, then yeah, obviously do that. Do the other one. Do that one. Don't invest into DGRO. Invest into the future that you can predict. Intel regularly grew the dividend up until 2023 when the amount was slashed. The whole problem was focusing on the dividend payout is that the amount is controlled by the BOD and missed the underlying financial issues the chip giant started facing in late 2020, while the other chip companies built on prior growth, leading to vastly different stock gains and 3 chip companies. So he's saying, don't buy DGRO, go back in the past, time travel, buy AMD and Nvidia instead. All right, thanks, bro. Great advice. This is great. Okay, so over the last decade, AMD and Nvidia had massive gains topping 5,000. Whenever you read an article and the guy compares Nvidia and AMD stocks that went up a lot and compares it to anything else, you know that the article is trash. I'm sorry. If you ever read articles on it on Seeking Alpha or anywhere, the Motley Fool, and they are comparing Nvidia to anything else, it's lazy writing and it's a trash article. So I read this and I'm just like, this is so stupid. Okay, this is ridiculous. Due to dividends, the total return was closer to break even, but investors focused on dividend growth missed out on these gains. So the history of Apple generally highlights the additional problem of focusing on dividend growth. The tech giant is now one of the largest holdings, but Apple didn't pay a dividend until 2012. The company wouldn't have qualified as a consistent dividend grower until years later. So he makes a very good point here that growth stocks are not included into this index because they haven't paid a dividend for at least 10 consecutive years. Now, this is very, very important that you understand. DGRO actually only requires companies to have paid them for at least, have grown them for at least 5 consecutive years, where other ETFs like VIG or Noble, they require them to pay it for 10 years or 25 years in the case of Noble. Now, this is a very fair argument that a lot of, growth stocks are not added or included in these ETFs because they're not allowed to, because they don't fit the screens for this index. Now, this is intentional. Somebody that wants to invest into a DGRO, a VIG, or a Noble, these dividend-focused ETFs, they're focused on companies that have proven themselves and that are already at a later stage in their maturity. They're not including just random IPO companies that don't pay a dividend. Right. And so, yes, of course, these indices are going to, in many cases, underperform the market that are including, growth stocks like NVIDIA or AMD or other companies that don't pay a dividend. And you've heard me many times on my channel say that total returns absolutely matter. Not every investor has the same goals. If you have a long-term time horizon, yes, absolutely, you want to focus on growth and total returns. If you're nearing retirement, you don't want the volatility that comes with investing only for total returns and growth. You want a little bit more stability. Maybe you want more income. And so it's incredibly important to understand who your audience is, who you're talking to, because an article like this, not an attractive dividend growth play, is just ridiculous, because an investor who is, nearing retirement or more income focused, this is a great option, right? Somebody that has maybe 30 years before they plan on retiring and they only want growth. Well, yeah, DGRO is not going to be the best choice for them. They're going to likely want to go and focus on companies that, or ETFs or whatever, that are growing faster, right? So it's important you understand who you are, what your goals are, because this article, it really depends on what camp you're in and what stage of life you're in. Dividend growth investors would have done exceptionally well owning Apple over the last decade due to focusing on dividend growth, but earnings were the key to originally buying Apple. The tech giant didn't originally pay a dividend due to focusing on growth, not capital returns to shareholders. Now dividend growth is a near requirement due to market dynamics, even though the company is facing issues growing earnings. Basically in line with what I was just saying. So lagging returns, the ETF does pay a 2.2% dividend yield, but even the S&P 500 pays a 1.2% dividend yield. You mean like 50% less? Like 50% is a lot, considering how much you need invested if your goal is to live off of the income. An investor in DGRO hardly obtains a material dividend, while the end result is underperform the S&P 500, while mainly holding the biggest stocks in the benchmark index. So where he really misses the mark here is not really understanding what that means for income investors. If you're investing for the yield, a 50% lower yield is substantial. If you need to have 50% more capital invested to live off of the income, that is a very, very big deal. And if you look over, the last 10 years of DGRO versus the S&P 500, if you're focused on the income, you've generated 50% more income without having to sell your shares. Now, this is the whole debate. Is it more efficient to sell your shares? And, you're going to, the 4% rule versus, dividend investing, to each their own. And so this is kind of the back and forth. Do you go with the 4% rule? Do you go with dividend investing? I'll leave a link at the end of this video to a video that I made on why I chose dividend investing versus selling my shares with the 4% rule. I think that might be interesting and may answer a lot of questions if you're kind of in a similar situation, like, hey, do I go, the dividend route, or do I go, the 4% route? Well, anyways, the good news is that DGRO has generally produced solid returns for investors over the last decade. The ETF is up nearly 19% year to date, but the bad news is the S&P 500 has returned 23% in the same period. Okay, the fund seems to routinely trail the returns of the benchmark index. These results beg the question of why investors don't prefer to just own the index. Well, I kind of touched on that, and I touched on that in this video, because you need 50% more capital invested to generate the same income. And this income is growing faster. That is why. A big reason to find an investment option attractive is the ability to beat the market with less risk. DGRO has shown no ability to beat the market, and the holdings lists show signs of extra risk with a tilt towards volatile tech stocks. Wait a second. This doesn't make any sense to me. DGRO has shown no ability to beat the market, though it's beat the market 4 out of 10 times. So it's not, it's trailed the market on a total return basis about half the time. And the holdings list shows signs of extra risk with a tilt towards volatile tech stocks. This sentence doesn't make any sense to me because it's so off. 7 out of 10 of the top holdings have outperformed the market, so that doesn't make any sense. And the volatile tech stocks, the S&P 500 is over 30% tech. DGRO, on the other hand, only has 18% in tech. So why is he saying that there's more volatility in DGRO than the market? This guy, I don't know what this guy was thinking, and I'm just confused by how, I'm going to use the word of the day, ridiculous. Why is this so ridiculously written? Doesn't make any sense to me. So the index currently trades at a 21.7 times earnings. So the stocks aren't exactly cheap. While not paying an impressive dividend, the risk here is that the expensive tech stocks in the fund will ultimately generate subpar returns. Is he referring to the 6% in Microsoft and Apple? The risk here, he's zooming in on the 6% in Microsoft and Apple as the oh my gosh. Okay, dude. Okay. The takeaway here. So the key investor takeaway is that investors chasing dividend growth via owning the largest stocks in the world only appears to add up to market underperformance. Investors would be far better off investing directly into the S&P 500 or hunt for an ETF better tied to finding stocks trading at attractive prices with dividend growth. All right, so that's the article. Let's take a look at a few comments. There's not a ton of comments on here. Let's take a look at it. So better to hold individual stocks if chasing dividend growth. That said, I've held DGRO since August 2020 and am up 60% excluding dividends. So I'll take that. Yeah, I mean, you're up great. Like DGRO is a great way to get dividend growth. It's a great way to invest for dividend growth and not take on the single stock risk, right? If you're chasing dividend growth and you're only investing into individual stocks, those individual stocks are great until they're not great. Okay. And with DGRO, you can truly sleep well at night because you don't have to worry if your stock is the next Intel or the next NVIDIA. It doesn't matter. You're buying the index. And what you're investing in the rules of the index. A fact that this, article doesn't even mention, which is ridiculous. If you're ever going to review an ETF, you have to understand how the index is set up. So just really lazy writing, in my opinion, when it comes to reviewing this ETF. If you don't even look at the index of the ETF, it's really, really lazy writing. Anyways, so let's see here. So great question. I was wondering the same thing, especially as a holder of DGRO. I like to pair it with SCHD. There you go. SCHD and DGRO, they go better together. They complement each other so well. That's why I talk about them on my channel. That's why I talk about the simple path to wealth with dividend investing, which was inspired by J.L. Collins. By combining SCHD and DGRO, you're getting more market participation. You're getting more exposure to different sectors in the market. You're casting a wider net. If that's kind of how I look at it. And you have more potential for growth in the future. And you just don't know what the market's going to do. You don't know if, NVIDIA is going to go up 5,000% or go down 4,900%. Like you just don't know what's going to happen. Okay, really quick before I wrap it up here, I want to show you the Morningstar US Dividend Growth Index. This is the index that DGRO tracks. So the way that this index works is it first looks at all companies in the United States, publicly traded companies. And the first thing is, in order to be eligible for inclusion in this index, is they exclude REITs entirely. So there's no REITs in this index. So that means it is 100% a qualified dividend. And also another screener here is the indicated dividend yield must be in the top 10% of the universe. And as well, they must have a positive consensus earnings forecast and a payout ratio less than 75%. So the reason why the dividend yield is so low is a lot of utilities, a lot of sin stocks are excluded from this index. You're not going to have like tobacco stocks in here because a lot of them have over a 75% payout ratio, right? So that is why you're going to have very, very large companies, but only companies that have a lower yield in that sense because they have a lower payout ratio. And this is a great screen when it comes to the dividend safety right? Once the payout ratio exceeds 75%, they will no longer be eligible for inclusion when they do a reconstitution in the next year, okay? And that's why it's kind of that survival of the fittest. If a company has a higher payout ratio, well, they are excluded from the index. And when you invest in an ETF like this, you don't have to manage this yourself. It is all managed for you with the rules of this index. And then lastly, the companies in here must have increased their dividend for at least 5 consecutive years. Now, I really like this. I like this more than VIG and Noble because it includes companies in here sooner, right? I'll give you an example. Microsoft and Apple have been included in this 5 years before they were included in VIG. And so, and it even goes beyond that when you think about Noble, the Dividend Aristocrat ETF, the companies have to have increased their dividend for at least 25 years. So this is one of the things that I like most about this ETF is only after 5 years, a company is considered eligible to be part of this index, and they have to have at least proven themselves for at least 5 years. So I like this because you're not going to see those massive fluctuations in the dividend income because they're screening companies for quality and consistency, and I really like that. Now, the part that is a little bit confusing is the next part of the construction, how, you take these eligibility factors and then you weight the companies, and how they're weighted is they're not weighted by market cap, but rather they're weighted in proportion to the value of their indicated dividend payments. And a 3% cap is placed on the weighting of each individual stocks. So you're not going to have a single stock be over 3%. And if they are, they do a rebalance quarterly, and they will rebalance those so that no one single stock is over 3% longer than, 3 months when they do the rebalance. So with that, another thing that is really important to understand is that all stocks from the Morningstar US Market Index, that's this index, that meet the eligibility requirements are included. The index constituents are weighted in proportion to their indicated dividends, which tilts the portfolio towards larger and higher yielding stocks. So after all of those, those screens, they then weight them based off of towards larger and higher yielding stocks. So that's what I was referring to when I was talking about the summary of this article, when he talked about, them only focusing on low dividend yields. No, the way that the index is set up, it doesn't support that. But all in all, I would give this article an F because this article just misses the mark. It misleads you in terms of not really understanding what the index is designed to do. It tells you that you would have been better off just buying the S&P 500, even though you would get 50% less income. He complains that the index doesn't have enough non-paying dividend stocks to boost its growth, clearly just ignorant to the fact of understanding who would want to own an ETF like this, right? And understanding the differences between a growth investor, a SPAC investor. I'm still not going to forget that. A SPAC investor is reviewing a dividend ETF. I mean, give me a break. Why are you even reviewing this article in the first place? That's like me writing an article on Bitcoin and complaining that Bitcoin doesn't pay a dividend, right? That's what this is like. So yeah, with that, thank you so much for watching. I'd be curious to hear your thoughts. What did you think about it? And I'll see everybody in next week's video.